from Lexington, Massachusetts, we have Nigel Gault, who's a chief U.S. economist at IHS Global Insight, and he joins us for more on the narrowing gap between China and U.S. trade. This is pretty interesting. But before we focus in on that particular relationship, let's talk about this pattern so far. So we have the U.S. seeing its deficit widen, whereas China actually reported its first trade deficit in 6 years. Is this a continuing pattern or maybe a one-month anomaly?
Certainly in the U.S., I think it's a one-month move. There were some special factors this month that widened the deficit a lot. It was a particularly bad month for aircraft exports in the U.S., so that hurt. There was a big payment for the rights to broadcast the Winter Olympics that hit the services account. So I think overall, this sharp jump in the U.S. this month is probably going to prove a one-month affair. I think we'll see the deficit narrowing again in the next month.
Oh, that's interesting. Even the Winter Olympics had an impact on the deficit. So let me just ask you about the currency debate then, Nigel, because, you know, we have the U.S. and the U.S. lawmakers trying to press China to do something about its currency, the yuan, at this point. But, you know, with them having a larger deficit, China in deficit at this point, and the gap narrowing between these two trading partners, I mean, is there still a viable case?
Yeah, I mean, I'm not sure all of these numbers make a big difference to the debate. I mean, I know that the bilateral deficit did narrow this month, but it always narrows in February on a seasonal basis. And if you take January, February combined, it's roughly the same as last year. Also, I think that the fact that China itself is in an overall deficit right now does reflect the extremely strong growth in the Chinese economy, strong domestic demand right now. I don't think that has a big influence on the debate over here. In the US, the debate is really driven by what's happening to US unemployment. And that's the thing that's causing the pressure from the US side for action. And unless there's some miraculous turnaround in the US labor market very, very quickly, Congress is going to continue to be pressing for action on the currency.
Yeah, you do hear Congress talking about the jobs being flooded out of the borders into other markets because of people and other countries keeping their currencies fixed. But do you think that's a legitimate argument? Because you see other countries that also have a trade deficit with China not complaining, such as South Korea and Japan.
Yeah, no, I think there's a very legitimate case that the Chinese should start to let the currency rise. I think it's good for both sides. The US needs export-led growth. China needs to be a bit more reliant on domestic growth. But the arguments that we're seeing coming out of Congress regarding the extent to which US unemployment has been in some sense caused by the misvaluation of the Chinese currency, those arguments are very, very much exaggerated. But it's still the right thing to do to let the currency start to rise.
Okay, well, Nigel, let me ask you this then. I know you're a U.S. Economist, but I guess you have to have some global insights. But when you have the U.S. Treasury delaying their foreign currency report, really a show of face for China to not label them as a currency manipulator, do you think this will push China, say, in the next few months or even earlier, to move on their currency?
Well, I think it opens the door for China to move. The US is giving China the opportunity to move without looking like it's being pressured by some precipitous action on the behalf of the US. And I have to believe that in the background, negotiations are going on, and we are likely to see China start to move very gradually around the middle of the year.
Around the middle of the year. Okay, Nigel, thanks for sharing your time. Thank you for that. Nigel Gault, the chief economist at IHS Global Insight, joining us there from Lexington, Massachusetts.